Okay, we now move to the performance evaluation chapter, and here we are going to look at different ratios and performance measures like Sharpe ratio, Reynolds ratio, Jensen's alpha, information ratio, and M square, and how these trading practices of hedge fund complicates the process of performance measurement. So there are two things here to start with. One is the dollar weighted return and the other is time weighted return. So dollar weighted return is nothing but the internal rate of return, and time weighted return is the return that is classical, which is the holding period return. So those are the two return types. In the risk adjustment performance matrix, we have Sharpe ratio, Reynolds measure, Jensen's alpha, information ratio. And an interesting thing to note here is that all ratios on the top have something like return, and on the bottom some parameter of risk. So to start with, the Sharpe ratio has standard deviation as its denominator. The Reynolds measure has average beta as its denominator, and when we look at Sharpe and ratio, one takes into consideration the systematic risk, another takes into consideration the total risk. So Reynolds, we can use Reynolds than using Sharpe, because Reynolds consists of only systematic risk of the portfolio. So since the Reynolds has beta, beta represent the systematic risk, whereas the standard deviation in the portfolio is due to many things, so that's a kind of total risk. Having said that, we move to Jensen's alpha, which is the return of the portfolio and how much it is being excess return than the account. So it's the excess return, and if we were to look at the excess return of market, then it becomes risk free into beta into risk of return of market minus risk free. So how much superior the portfolio manager has performed in relative to market, and that helps us to give the alpha, which is also known as Jensen's alpha. A term that's often seen here in most of the times is information ratio or appraisal ratio, and that is the return, the average return of the account minus average benchmark return divided by standard deviation of excess return measure as a difference between account and benchmark. So of course when we look at how much better we are doing, so we are actually dividing the Jensen's alpha with the standard deviation of the differences. So first we have taken the differences from the market, and then we are on the denominator taking out the standard deviation of the differences. So that's we are calculating the surplus return upon surplus risk. Then we move to M square measure, and it's again another way, and to understand this you need to understand the capital market line, capital allocation line, and it's the excess return of the portfolio and the market index. So that's about the M square. So in M square we find out the return of the portfolio, and then we subtract it from the return of market. But return of portfolio we find out by giving by investing into risk-free and by investing into a risky portfolio, and that's how we move ahead to find out the return of the portfolio. Now when we move to the next topic, which is the significance of alpha, we are looking whether this alpha is significantly different from zero, and to do that we divide it by the volatility, but we take the standard error of the estimate, so we divide the volatility by root n, which is the number of observation. So that is the difference. Otherwise we could have taken the alpha volatility directly, but since we are talking about a small and we'll be using t statistic, so we took the standard error of the alpha estimate and divided the alpha estimate volatility by the root of number of observation. So actually we have scaled it down to the number of observations that we have, and not just used the normal distribution standard deviation, which is for like many readings. So that's how we scaled it down, because in the other case, in the VAR measures, we did not did this, where we brought down the alpha estimated volatility by dividing it by the root of n, which is the number of readings or the number of observations. So after that we have the measuring hedge performance, and the issue here becomes complicated because hedge funds risk is not constant over time. It's non-linear. Hedge funds are often illiquid, and they do a lot of data smoothing. Hedge fund sensitivity, traditional increase in time of market crisis and decreases in market strength. So the estimate process unduly smoothen the hedge fund value, increasing serial correlation into any statistical estimate. So because the long short fund is market neutral, alpha may be generated outside the investor desired asset mix, and alpha does not depend on really the performance, but many of the time the way in which we take a theme out of the hedge fund. So when we have dynamic risk levels, we have to understand how to use it. So in the dynamic risk, Sharpe ratio seems to be biased downward due to the perceived risk increase in the portfolio return. In isolation, both low risk and high risk strategies produce higher Sharpe ratio than the market. So that was the part that we need to think on. So Sharpe ratio is useful when evaluating portfolio of a passive investment when risk and return are relatively constant, but the application of Sharpe ratio is challenged when the performance of active strategies where risk and returns are more dynamic, and changes in volatility will likely bias the Sharpe ratio and produce incorrect conclusion while comparing portfolio performance to benchmark index. And then we have the last topic here, the market timing ability. And when we extend the basic return regression model, we add a tool to assess superiority market timings of a portfolio manager. A market timer will include high, low, beta stocks in her portfolio if she expects an up down in the market. If the forecasts are accurate, the portfolio will outperform. And using market timing regression model, we can empirically test whether this was happening or not. So in this kind of a model, we have MP into RM minus RF. So we basically look for portfolio minus market, and we have an MP, which is the difference between the market returns. And now we move to the last topic, that's style analysis. So William Sharpe introduced concept of style analysis, and from Jan 1985 to December 1989 he analyzed that the returns of Fidelity Magen funds for style and selection bias. And what he did was that he ran a regression of portfolio returns against exhaustively and mutually accurate set of asset indices, and return of managed portfolio and return on various benchmarks were regressed, and then he conducted a performance attribution, and then he did a selection attribution, which equals the difference in return attributed to superior individual security selection and sector allocation. And so basically he was trying to find out how much returns are explained by different types of large cap, mid cap, small cap, growth cap, value cap. Funds performance was measured. So we are sitting outside and we are looking at the asset allocation in a hedge fund, and regressing it with different kind of strategies, like getting into passive funds like small cap, mid cap. So this was the model, and what we found was that we could describe it by these four things, which is return on large cap, small cap, and growth index and value index. So growth value is so growth are those who are growing, and value are those which has already reached a level of performance like Microsoft or Google. So the growth value is there from a long time. So that was all in the performance ratio portfolio analytics. I hope you liked it, and thank you for listening.